Good morning, ladies and gentlemen. It's wonderful to see so many of you here again today. I'm going to take you a quick rattle through a number of the personal tax changes that are going to apply to clients, business owners and private individuals. Predominantly, a lot of the stuff wasn't announced yesterday, but it's going to hit the pockets in about a month's time once we get past the start of the new tax year. Firstly, some good news. We have an increase in personal allowances, now up to 11,500 next year. The government's aim is to get that up to 12,500 by the time we get to the start of the new Parliament. And the one thing to bear in mind with that is that your personal allowance will actually be lost as your income starts to exceed 100,000. So what we're seeing is clients with incomes of more than 100,000 are having a band of income getting larger and larger where there's a marginal tax rate of 60%. Effectively, you pay 40% tax on that income as normal, and you also then lose part of your personal allowance as your income tips over 100,000. The big change we've seen this year is the way bank interest is now taxed. Historically, it's been taxed with tax deducted at 20%, and any personal tax is paid via self-assessment. The government have now decided to completely get rid of that, and all bank interest is now paid gross. That means the government could, if they weren't sensible, get many small tax returns. So to get around that, they've given a personal savings allowance, which for a basic rate taxpayer means they can get £1,000 of interest income tax-free, a higher rate taxpayer 500, and an additional taxpayer, they don't get that allowance at all. They've also changed the way dividends are taxed, and we've got another allowance therefore now, a dividend allowance, which I'll come on to in a little while. Tax bands have also gone up. We still have a band of income if you don't fully use your personal allowance. So the income sits on top of your personal allowance. If it's interest income, is taxed at 0%. That could be important for the family business, and I'll come on to that later. Again, we've got an increase in the basic rate tax band. So for next year, basic rate tax will be paid on the first income up to 33,500, meaning that the total tax payable at basic rate before you have higher rate tax will be 45,000. So a gradual increase to the government's aim to get us up to 50,000 by the end of the Parliament before higher rate tax is paid. The government have also recognised there are a number of small traders or people renting out their driveways, little parts of property, where there would otherwise be some very messy tax returns with little return. So they've now given another tax allowance for trading income where it's a very modest amount of up to £1,000, or if you've got some Airbnb income or something like that from renting your property, again up to £1,000. So what we're starting to see is the government give an awful lot of little allowances which with right planning can actually add up to a lot of money. The big change we're going to see coming on the 6th of April is, or we have seen and will hit this year, is the way dividends are taxed. Historically, if you're a basic rate taxpayer, you didn't pay any tax additionally personally on your dividends. We're now going to see for the first 5,000, that won't change, but thereafter you're going to be paying 7.5% personal tax on those dividend income. That's not only company owners, that may be people living off their investment income in retirement, or somebody with an investment portfolio they may be using for other purposes. Those tax changes are all going to apply to other rates as well. So if you're a higher rate, you'll now pay 32.5% of your dividend as higher rate tax, and if your additional rate, 38.1%. We've seen in the news recently that government finances were supposedly in really good condition, and there was massive tax receipts in January. What the government or the press haven't really picked up on is that's probably because people were advancing their dividends into 2015-16, and all that additional tax was then paid this January. I suspect that won't be repeated going forward. So the dividend allowance is given. The government, again, don't want small tax returns. If somebody's got a modest amount of investment income, either from their company or from an investment portfolio, the government don't want them filing tax returns, so they've given a £5,000 allowance. What the government also recognised yesterday is that, in fact, that may encourage people to incorporate their personal business to try and take advantage of that allowance. So although it's a brand new allowance that's only just been introduced, from 2018 the government will reduce that to £2,000. So impact of that in terms of people's pockets. I've got some examples on the screen there where somebody uses their personal allowance through other income, perhaps salary from the company or a pension, and thereafter they've got some dividend income. So even at very modest levels of dividend income of 20,000, we're going to see over £1,000 of additional tax. You'll see there as that income increases dramatically, somebody with 80,000 is going to face a tax bill of over £5,000. That's no extra income, but additional tax. And that tax bill won't hit until January next year. So it's really important in terms of planning your 2017 tax returns that they're done as soon as possible so that you know what that additional tax is going to be. All these allowances actually give us some opportunities though, and talking to clients, it's quite interesting to see how people extract income from their company. Many families are surprised to find that with all these allowances, it's possible to get £3,500 per month out of your family company without any personal taxes. Using that personal allowance with a salary, some interest on your director's loan accounts, which many family companies are financed by, and then using the dividend allowance means we can achieve that level of income for a husband and wife without any personal taxes. There are some warnings that go with this. Self-assessment, if you're an individual, if you have a liability, it's your requirement to tell HMRC that there's a liability. HMRC won't write to you and say, I think you've got some dividend income, you need to file a tax return. They will expect you to know. That may be you, that may be a family member. There are going to be an awful lot of people who are going to have to file tax returns who've perhaps never had to file one in their lives. Some of our clients where they're living off investment income, they may have 20,000 of dividends from their investment portfolio and they've never filed a tax return, and they're now going to have to for the first time and also know that fact. So more complexity. If anybody has a home in Scotland, they're subject to UK tax rates, but we have a Scottish rate of income tax. In their wisdom, they didn't change the actual rate of tax, but they didn't increase the basic rate tax band. So for a Scottish taxpayer where their employment income or non-dividend or non-interest income is above 43,000, they will start to see higher rate tax. To see how incredibly complex the legislation is, that individual has to then apply the UK tax rate to determine their higher rate tax on their investment income, which means that doesn't kick in until 45,000. So our UK tax system is getting incredibly complicated. Moving on to some planning points, we always mention annual allowances for pensions, incredibly powerful over a working lifetime. For the family business, this can really help with succession planning, as you've got a pot of money that you can draw on at a time when the next generation may want to take the family business forward. These allowances are now to put up to 40,000 per year in, and incredibly powerful in terms of tax relief for either 40%, 45%, or perhaps even 60%. There are some changes this year for higher earners, which we're now seeing the impact of, in that if your income is over 110,000, you could find the government take away that pension allowance. For people making pension contributions, it's quite easy to calculate what that additional allowance or adjusted allowance may be, but for somebody, perhaps if you've got a final salary pension scheme, one of the universities, or if you've got a city job where it's still got a final salary pension, that is incorporated into this calculation. And we're seeing a lot of clients completely unawares, actually their quite gold-plated final salary pension scheme could actually cause them a personal income tax liability. Other changes, Buytolet property investors, some significant changes coming in on the 6th of April. A number of people still aren't fully aware of these. The biggest one is the impact of how interest will be claimed for tax purposes. The government have phased this in over a 4-year period, such that by next year we'll be able to claim 3/4 of the interest in the normal way, but a quarter of it will be only giving you basic rate tax relief. Over 4 years, this will be completely phased in, so that by the time we get to 2021, you'll only get basic rate tax relief for your interest on buy-to-let properties. Many people, the effect of this isn't really known. So on the slide here, you can see the additional tax that somebody with a modest amount of income up to their basic rate tax band, perhaps from employment or pensions, and then living off their investment portfolio of properties. Somebody with 5 properties with quite heavily gearing might see an increase of tax of £5,000. We're seeing clients with 20 or so properties seeing significant £20,000, £30,000 of additional income tax just through these tax changes. We've also got some changes to capital gains tax, again pre-announced over a year ago and now really having an impact. These don't apply to non-residential property, and the government have put various signals out that they wish people to invest in other areas such as stock market investments. So they've reduced the rate of capital gains tax applying to those investments down to 10% if you're a basic rate taxpayer and 20% if you're a higher rate taxpayer. For some of our clients, that means they're using this as an opportunity, perhaps to rebalance portfolios they may have had for 20 or 30 years, because this rate of capital gains tax is actually incredibly low in the overall context of historical rates. Also saw an increase in the capital gains tax annual exemption yesterday, announced to 11,300 from the 6th of April. That's available to both husband and wives and is effectively a way of generating some tax-free income if you've got an investment portfolio generating gains. There's also an extension to entrepreneurs relief. It's been in place for about a year, but is still very little understood. So if you're an investor who maybe you're already using your entrepreneurs relief, you may have opportunities to invest into other companies, and providing they're held for 3 years, you'll be able to achieve a 10% tax rate on any exit. We've also seen some changes to inheritance tax reliefs. I've put on the slide there all the reliefs that potentially clients can use, but the most important one we've seen changes to is the second one on there. That's the residential nil rate band. The government pledged at the last election that they would allow families to pass on £1 million worth of assets to their next generation inheritance tax free. Rather than doing the simple thing and just increase the inheritance tax nil rate band to £500,000 per individual, so £1 million between a couple, they have instead introduced some incredibly complex legislation that allows you to claim an additional residential nil rate band against your family home. A number of the lawyers in the room will be fully aware of this in talking to their clients. Actually, for a lot of people, this means rewriting your will, or at least revisiting it to make sure that your will allow you to claim this. There's a lot of cases where actually you won't apply because your will doesn't allow you to claim the relief. The change is going to be introduced in stages. So from the 6th of April, each individual will have a 100,000 residential nil rate band, increasing in £25,000 steps, so that by the time we get to 2021, we'll have 175,000 each. So when added to our normal nil rate band of 325,000, we get to the magic £500,000 per individual, or £1 million per couple. So really, to summarise what I've talked about today, I think there's some action required. Make sure how you remunerate yourself and your company as tax efficiently as possible, and particularly take into account the dividend tax changes. Those won't impact in terms of tax cash flows until January 18, so make sure when doing your 2017 tax returns you're well aware of what's coming forward. And again, for property investors, in terms of cash flow, that's not going to kick in until January 18, but with less than a month away till the actual legislation applies. If you've got anybody within your family or people you may know, there's going to be a lot of people having to file self-assessment tax returns. Across the group, we deal with over 2,000 tax returns, so we will come across the situation that somebody may have come across. In terms of planning for the family, inheritance tax planning is still one of the most powerful things you can do, and it's important that you review your will to make sure that it's fully up to spec in terms of the new residential nil rate band. And then, as I've shown in this presentation, hopefully, there are a phenomenal number of allowances now available, but each year those allowances are lost if we don't use them. So in terms of planning, make sure that you fully utilise every allowance available.